Happy Wednesday. We welcome you to Trading Growth and Value Stocks. My name is James Boyd. Alongside me is Ben Watson in the chat. We could also call him the Ben Watson. Yes, he's with us. So we'd like to welcome Ben, Grace, Amanda, Andy, Sharon, Fayez, Greg, Will, and many others. Welcome to all. Now, this class, again, we're going to focus probably on both here today, growth and value. Want to really talk about today, let's say some stocks that have fundamentally, historically, maybe struggled a little bit, but might be snapping back. Second, we're going to kind of talk about some stocks that have kind of been more proven over time, where that trend of technical analysis is still going, and maybe the fundamentals are still strong. We'll talk about both sides here today. Now, remember when we talk about examples, I do post examples on my X handle. And my handle is at James Boyd CS, capital J, capital B, CS. Ben will post his handle in the chat. That way you can just directly link to it. Check that out. We do post announcements there as well. Now, remember when we talk about the information is provided for general informational purposes only, should not be considered an individualized recommendation. You decide what you want to invest in and if you want to invest. Remember that Schwab does not recommend the use of technical analysis as a sole means of research. There's other types of research that can be very interesting as well, not just technicals. Just know that. Very exciting. I won't even go there. Yeah. And also remember that the paid money software application is provided for educational purposes only. Also understand that if we bring up dividend-paying stocks, they may reduce or stop paying dividends. They may do a special cash dividend. They actually might increase the dividend. The moral of the story is it's not ongoing. It could change, okay? And also remember that investing in stocks involves risk, including loss of principal. Now, when we talk about our examples here today, I mentioned we're going to focus on, right off the bat, a stock that has maybe struggled financially a little bit, fundamentally as well, but maybe a snapping back. I want to look at that immediately. Second, we're going to look at an example where the stock has actually done a little stronger, and I'm going to kind of show some of the differences. Now, first off, and as I do that, I will look at the S&P 500 and just real quick the sectors. So let's go there first. So let me bring up, let's say, the market. When I say market, I'm saying the SPX. Just quickly, if you look at the SPX, we're still in the green shading, just saying the short-term moving average is above the 20-period moving average. We're in between the moving averages. You got to remember the whole moving averages, which these are very short term, okay? So if you come off at all, it's likely to get below, okay? And you see it got below the 10. Now we're in the process of really making the higher low. If we ever ask ourselves the question, how do you see a higher low? It's an easy answer. The higher low is the red and green candles side by side. So this area of about 68.20 or so, that's the marker. If we can stay above 68.20, this is still trying to make that bull flag pull. The pull that we've actually had has been one of the stronger ones we've seen lately after a sell-off. And you're going to see that the pullback so far, how far have we pulled back from the very top? The answer is not much. If 68.50 was the high and we only fell down to 6,800, we fell within 1% of the high. So if we're talking about, like, is there heavy selling pressure? If there is, you can't tell because it didn't even go down 1% from the high, okay? Now, just real quick on the front of, let's say, sectors. The one that we talked about yesterday is the transports. We talked about United Airlines, Delta. We also talked about, for example, Love, Southwest. Alaska has been the one that's been lagging a little bit. That sector has actually done quite strong. Of course, it's been helped a little bit, perhaps, by crude oil just kind of staying pushed down. Price per barrel here is about 59 and change. Kind of ugly, right? However, there is some interesting things happening where when you look at the price per barrel, it's down, but when you look at the sector, it looks a lot stronger than the price per barrel does, okay? Now, keep in mind that there are some energy stocks that are actually getting a little bit of a push, okay? And so not all stocks are going to be exactly what the price per barrel is or the sector is, et cetera. A couple stocks that kind of came out here today was Apache, or APA. And you're gonna, and I think that they changed that. Let me just go back to this just real quick. No, it's APA. It is APA. Okay. And what you're going to notice is when you look at that chart, that was a fresh breakout on that one. The other one that's kind of been trying to break out is the BKR, which is Baker Hughes. Okay. So APA, BKR, those are some stocks to maybe watch in that space. Now, let's go back to just real quick. One of the stocks that I want to start talking about just right off the bat, okay? It's going to be our first example. Now, sometimes when we talk about technical analysis, we look for, let's say, stocks sometimes if we're talking about a setup, okay? So when we think setups, we could say it's a bounce, it's a breakout. And if we kind of say, look, can we kind of take that idea of a breakout and kind of even dig into that a little bit further? Well, sometimes you can actually get, let's say, a breakout where it's not necessarily that it actually breaks to the top side, like copper did here today. Okay, don't even start talking about copper. But the biggest actually thing is sometimes the breakouts could actually be something where it broke down and where the price is breaking back to the upside where it fell down from. Now, for some investors, this is maybe one of their favorite setups outside bull flags. Because if investors are buying below the support level, why would someone be buying below a support level if they did not think the price could go back up? Now, you could think a lot of things. It doesn't mean it's going to happen. And so what we're seeing here today on the hood ticker symbol is a snap back up. So this being the old support, as Ben says, this should be resistance, but that resistance so far is not holding. The MACD is actually staying above the zero line. And what you're going to see is when we go to the technicals, I want to kind of show you something on this that's a little different, okay? So what you're now going to notice is if we go back and look at, let's say, the Analyze tab, we go to where it says Fundamentals, you're going to see that the story of the fundamentals has been tough, okay? And what you're now going to notice is, and I'm going to show you two differences. I'm going to probably show you three financials, okay? When we look at, let's say, the sales per share, nothing really that great, okay? I mean, it cut in half. And this is where investors say, geez, maybe I like a company that's a little bit more consistent, okay? Because if your sales drops like that, your earnings per share is going to be all over the place. And then valuation, how do you even know what's going on? This is the risk. This is why some of these on a percentage basis move so much. Now, what you're going to notice is from the 22 to 23, again, they went up about 30%. You go from 209 to about 326. They're up about 50%. So big swings in sales per share, think revenue per share. But the biggest thing is, what's the forecast? And the answer is it's all over the place, okay? Now, there could have been reasons for that. They could have told investors, hey, we're making these capital investments. We don't think the sales are going to be that strong, etc. When you look at, let's say, when you look at some of these numbers like earnings per share, it also has been negative, became less negative, and then turned positive. The moral of the story is a lot of times people don't necessarily care that much about the past. They want to know what is it doing now. And if the company actually feels like, hey, we're going to a place of more revenue consistency and we have more of some confidence on the earnings per share, that might excite some investors. Okay. Now, the one thing we're also going to notice is here, and I've been kind of taking a look at a lot of this lately, is this ROE. Okay. The ROE is the net income. Okay. And it's really over equity. And you're going to see that some investors, they really like that double digit. It's sitting here about 19. Now, when you also look at the net profit margin, which is kind of important, of course, you're going to see that it's at 47%. Now, those are pretty strong numbers. Now, I'm going to kind of go back to this and let's look at this as our first trade example. We're going to right click on the chart. Now, this class is a stock class. It does not mean if someone said, hey, I'm going to consider a derivative, well, that's fine. They could do that for themselves. If we were in a derivative class, we could consider that. We're not. So I'm going to go ahead and do a stock trade. Now, what I'm going to do is I'm going to right click on this, go and go buy custom with OCO bracket. Now, you're going to notice there's two peaks on the chart. And we got to go to the right. There it is. Let me pull this up. There you go. Got to make sure. There it is. There. Okay, now I'm going to right click on the chart. When I right click on the chart with OCO bracket, why a bracket? Well, we're going to try to actually set a target right at the prior high. Which prior high are we talking about? I thought you'd never ask. And if we take a look at this prior high, there's two of them. Number one, got about 148. The second one really being about 152. I don't know about you if you like to set maybe shallower targets or targets not as distance. We're going to kind of set that target right about 148 and change. Okay. Now, Pia kind of mentioned the whiplashing of these fundamentals. Sometimes this is a company that doesn't necessarily, or this could be an example of a company where they don't have the consistent revenue streams. Okay. When you don't have the consistent revenue streams, you have those fundamentals that are just all over the place. And it's hard to really forecast the viability of the business if you don't have those consistent revenue streams. Okay. A lot of investors don't like that. So this is kind of more of a trade. Okay. Now, it's not saying that in the future they can't change that, or a company like this can't change that, but at least as right now, it's showing that whiplashing, okay, of fundamentals. Hence, the stock has actually been moving quite a bit too. So we got a target at 148. That's the target. And what you're going to notice is the stop. Now, just remember, just real quick, the stop is if the stock goes down to that price or less, it triggers to be sold, but it's not stating exactly what price. That's the risk of a stop. That's kind of funny because I think more than anyone in this company, I probably hammer puts and puts and puts and puts and more puts. But a lot of times people don't like puts because you got to pay for them, and then they have a low chance of actually being in the money at expiration. But there is a big difference between buying puts and setting stops. Buying puts, you actually have a right to actually sell the stock at the strike price, and actually, for example, from now to expiration. And then the stop is the risk of the stock. For example, you don't know what it's going to sell at. So that is a big difference. Now, if you want to learn more about that, go to a derivative type class. But I think that's why we try to harp on maybe having a right to sell at a set price. If that interests you, go to some of the other classes where they talk about that. But as a stock trader, this is the risk of it. We don't know exactly what it's going to sell at. Now, I went into that a little bit so you could kind of see up front what are some of the initial differences. Now, what I'm going to do is I'm going to set the stop right underneath where we think we have support. Where? Let's say we said we think support is right around 121.66. 121.66 less 2%. We're going to set it right at 119.66. Okay? 119.66. Now, got a target, got a stop. And by the way, when you look at this number, I like to kind of see the difference in the price difference. Okay, but you got to remember something. When you look at the price difference, that's going to be about, how much is that? 130. Let's get that off. Let's look at the differences. 130.15 is the entry, less 119.66. Now that's assuming that it sells right at that price. That's a big assumption. And now what you're going to notice is I'm going to say, okay, how much we buy the stock for? 130.15, and it's going to give us a percent. So remember, if we're taking 4 to 5% of the entry price, probably you're very close to support. If we're maybe 5 to 7%, we're a little elevated off support. If we're right around 7 or 8%, if the paper on the account is going to get in, I mean, hello, we're going to get in, okay? Because if we start risking more than, let's say, 8% plus, now we're a little elevated off support, and we need to have an idea that there could be some upside potential, okay? Again, that's a forecast. That doesn't mean it's going to happen. Now, what I'm going to do is I'm going to go to, got this in the margin account. We got to think about how many shares we could buy. Example given, we're going to put this to 50 shares, okay? So 50 shares, there it is, okay? Target, stop. We're going to go confirm and send. And the first trade example is hood, okay? There it is. We talked about the stop. I went into a little bit of the differences. I think that's important for you to understand the differences and why some investors consider one type of exit or way to try to get out versus another. We're going to go ahead and send the order. Notice there's not a commission. Send the order. And now that trade is sitting right there, okay? Yeah, so Pia says higher volatility stocks have wider daily ranges. Yeah, on a percentage basis, right? So that would make sense. So if you brought up a stock like Walmart, okay, so if we kind of said, well, now you could actually look at this in two different ways. The ATR, the average true range, is looking the last 14 days, that's the default. And it's looking from the low to high over the last 14 days and giving us like an average true range. That's on the nominal basis. Me, I like to look at it as far as a percent. I don't have the percent on this paper money account, so I like to see it in terms of percentage, okay? Because if you're looking at Bank of America versus Google stock, you're hundreds of dollars difference. But sure, the initial answer is yes, that would make sense. All right, now, Dragon Rider 1086, sorry for being late. We forgive you, but this time only. I'm just joking with you. Yeah, so here we go. So trade number one was actually Hood. The purpose, now by the way, have we filled? No, we have not filled. I'm going to move this up just a little bit. And I'm going to move it right to where the current price is. Now, James was talking about the differences between the stops and the defined risk, things like that, kind of showing pro and con, okay? That's important to know the pro and con. Don't just assume that oh yeah, the stop, that's a better way. Well, who says that, okay? Got to know both sides and why someone would use one versus the other or consider it. Now, one other stock I want to kind of talk about is, let's bring up a company like MS. Now, MS, we're talking about Morgan Stanley. Now, when you think about a company like Morgan Stanley, you're talking about a big company, okay? Well, let's go actually, they've been around maybe a lot, well, they have been around a lot longer. We're going to go to analyze for just a second, and let's kind of look at some of the differences for just a moment, okay? So if I actually go to just real quick, and this is going to be our second trade example. Now, of course, when we talk about Morgan Stanley, we're really talking about, in this case, another financial company. Now, when you look at the sales per share, I want you to kind of notice the differences, okay? 29, 32, 31, 32, 38. So immediately, what do you notice? What you kind of notice is it's just kind of more consistent. So when you look at valuation, whether you actually are trying to value the company based on sales or dividends or earnings, if those numbers are all over the place, the likelihood that you're going to be right is substantially less. If we look at, let's say, the earnings per share, 646, 803, 615, 518, 795, there's some variation, but at least it's all positive historically. It doesn't mean the future. But the biggest actually thing is if you said, well, what about these dividends? And this is where those investors who say, look, I want to know that the company is selling out to some dividends. If the company is selling out to some dividends, which can change over time, that actually says that they're pretty confident the company could be profitable, okay? Now think of this like a pie analogy, okay? So for example, if we're sitting here in 2024, and you got an earnings per share of $7.95. So this pie is earnings per share, okay? Earnings per share. And they're taking like a good chunk of this, and I'm going to write D for dividends. They're taking 363 of the 795 and giving it back to those investors. And it's leaving the company with a retained earnings of about 432, okay? So the company says, look, we'll keep 432 and we're going to give you, okay, right now, 363. And that's pretty nice. If the company is willing to do that, it kind of also states where they think they are financially, currently. Now, that can change in the future. But if they're seeing that that number is going up over time, now, by the way, that's a big jump in dividend. That's a pretty big jump in dividend. Hello, that's another 10%er. This is another 10%er. Now, I've said 3 times dividends can change, but if we're talking about dividend, like earnings per share, if we're talking about dividends per share increase year over year, a 10% increase, that's a lot, okay? Now, what I'm going to do is, if we talk about this when I go back to the chart for just a second, let's look at this on a weekly chart. I don't want anyone to think that we're just looking at daily charts and we're just short-term traders, okay? Well, that's what the class is, but that doesn't necessarily mean we're just doing it for a couple days. When we look at this over a period of time, there's been a horizontal breakout right around 140, and a little thrust to the upside past that 140. Now, we could say things like, well, it's too high, I can't go any higher. Well, you could have said that before. If we look at the chart here, what you're now going to notice is we have a prior high. And the stock actually fell down near the support area. Now, when you go back, I know you're thinking, my gosh, can we get another sell-off? But when it's happening, that's not necessarily what we're thinking. Can I get another one? When it sells off, this is why investors look for that horizontal support over the last 1 to 3 months. Okay? Can it fall down to a horizontal support over the last 1 to 3 months? And maybe, can it get a MACD divergence? Does every time is there a divergence? Not necessarily. I don't see something really super evident on this one that look at the divergence. And it doesn't happen all the time, but it did fall down to support. It did get a crossover. And then right now we're trying to get a little run to the upside and a little push. Now here's the thing. It doesn't matter if the indexes are at the all-time high if the investor's sitting in cash. Okay? Now, let's kind of think about this. Why is the paper money account investing? Well, it's trying to reach a financial goal. Now, here we are at the end of the year, and you might be thinking, well, what was the goal? What was it trying to do? You should be self-reflecting to yourself, how have you done? Okay? Are you out? What was your stated goal? Did you have a benchmark that you were trying to use? And where is that benchmark? And where is that account relative to the benchmark? Okay? And of course, from every year, you're saying, look, I could do things better, or do I want to actually change things and so on? And what did I do good? Okay. Now, and those would be some questions you want to be asking like right now. Here's the deal. When we look at this, we're probably trying to make that higher low right around 168. And there's kind of like that U or V pattern. Now, notice when we dropped, it's almost like a symmetrical right side. In other words, let's say it dropped for about 7 or 8 days and we went up about 7 or 8 days, meaning the symmetrical just meaning the number of days it actually fell down and the number of days it actually went back up, it's the same. Now, if on the right-hand side, let's say it fell down for about 8 days, and on the right-hand side, it took only 5 days to come back up, what does that probably tell you? People using that sell-off as a little opportunity, okay? Now, to me, it looks about the same, maybe a little bit less, but the shorter the duration it takes to go right back to the upside, the stronger the upside potential move potentially could be. Now, if I go back to this, I'm going to right-click on the chart, going to go to Buy Custom with OCO Bracket. So if we're talking about trading growth and value, okay, we're going to be using that bracket order quite a bit. Now, as I'm on this chart, I also want to go back to this just real quick where we had the prior high, okay? And I'm going to use that Fibonacci right down to that where we went down to. So notice I'm going from the body to the body. And this is why some people give me the nickname of James Body to Body Boyd. Kind of makes me feel like I'm like a wrestler or something like that. But actually, that's kind of cool. Now, here's the deal. If we take a look at this, you're now going to notice, I could tell you a story, might save it for later. But the biggest actually thing is when you look at this prior high down there, the extension target is really 171.11. And if you look at the 200%, it's really 181.58. Now remember, the 200%, not Fibonacci number, that's just taking the channel width. By the way, that kind of seems to be like a theme so far. That's true, okay? And what we're going to do on this one is we're going to right-click on the chart. Let's go back into paper money and make this one count. We're going to right-click right there. We're going to go to Buy Custom with OCO Bracket. What is that target? Now, again, we're going to set that target right at that 200%. We're going to put it right at 181. So 181-ish. Okay, now why not 181.58? Well, we're kind of shedding a little bit off that. Okay, wonder if we're a little off. We'd rather, well, sometimes we'd rather get out a little early than stay in too long where it doesn't go to the target and then falls back down. There's nothing probably worse. Now, if we looked at that support area, we said right around 168. I got to tell the story, okay? I lived in Bowling Green, Kentucky, and played football in high school and stuff like that. And I was down at this local gym, and I said to this one, this guy was in there lifting weights and everything, and all he had on was just like the coveralls. He had a big old beard. I said, man, you really look like a you look like Hillbilly Jim on WWF. And he goes, I am Hillbilly Jim. Anyway, his daughter, Joanna, she went to my high school. I said, I know your daughter, Joanna. It was just kind of funny. So I used to work out with Hillbilly Jim. One of the nicest guys you ever meet. My gosh. Anyway, so that's why I kind of said the wrestling. And yeah, I don't know if you ever get into that wrestling. My dad was a wrestler in college and stuff. Not that type of wrestling, but college wrestling. So anyway, I had to go there because some of you jumped on that. And yeah, it is kind of interesting. They are entertainers, but boy, there's some pain too. Now, if we take a look at this, if we went back to this, okay, so we got the target right there, and then the stop underneath, we actually said the number was 164.64. How did we get that? Well, when we typed in 168 less 2%, it's going to give us 164.64, okay? Dated GTC. Now, when we go back to the shares again and say how many shares, if we did about 6,000, if we set the capital size, let's say at the most is $5,000, it's going to be right at 29 shares, okay? 29 shares. If we go back and look at this, got an entry, target, stop, okay? Now what you're going to that's funny. Now here's the deal. Okay, some of you are funny people here, I can tell. Now, by the way, just because your spouse doesn't think you're funny doesn't mean you're not funny. Okay, that's not true. She's just he is just used to your jokes and doesn't appreciate them. Okay, and tell him or her. James said you need to appreciate my jokes more. I think that's a fair comment. Now, here's the deal. If we look at this, yeah, a little cloud, okay? The one thing you'll kind of notice is this is another example of a stock that is making a bull flag, but not much of a retracement off the top. Now, when I say that, why does it matter? Well, if you run to the upside, then remember, a typical bull flag pull might be, let's say, on average, not always, 5 to 7 days. Well, if we, for example, run up 5 to 7 days and then we don't even pull back down to the first retracement area, these percentages are just math of Fibonacci numbers. That's all they are, okay? So when we say 1, 2, 3, 5, 8, 13, and so on, 21, they're just Fibonacci numbers where it takes a lower number divided by a higher number and so on. That's how they're getting the percentages. And if we take a look at this, what you're now going to notice is we didn't even pull back down to the first level, at 78%. Now, does that guarantee that it's going to go to the upside? We're talking about stock investing, okay? This isn't CDs or something like that. So absolutely not. We're just forecasting. Maybe it could. Maybe other technicians are trading the same exact pattern. We're going to go confirm and send. Now, remember how the stop works. We talked about initially. What's the differences? Well, remember, this is not a right to sell. This is a trigger to sell. That's very important to understand the difference. What is a right to sell versus a trigger to sell? Okay? Now, the difference between this stop versus a right to sell is this doesn't have an expiration per se. Now, by the way, some of these stops, they might be good for 6 months or so. Check. But usually in our examples, we're not holding these 6 months. Okay? Now, if we take a look at this, it's a trigger to sell at 164.64 or lower, okay? So when could there be that risk of maybe having a gap? Probably on earnings is the biggest time, not the only time, but that's probably the biggest risk. That's why some investors say, James, I don't want to be in a short-term trade over the earnings where there can be a gap risk, where it's not controlling that risk, okay? This is a trigger to sell, of course. Now, I'm going to go ahead and send that order. There it is. All right. Now, if we actually said, hey, could we share this chart for just a second? Yeah. Okay. That's the chart. This is the main chart we actually use. We like it kind of for, by the way, why do you like this chart? Well, let's go back. I'm just going to kind of take a quick look at UAL for just a moment. UAL is one of those stocks that's actually kind of had a nice little push. Okay, we're just looking at the transport just real quick. There's Delta. We actually added to that position yesterday. And if you look at this, so let me just kind of answer, why do you like this chart maybe compared to what you used to talk about 20 years ago? There's some differences, okay? So when you look at an exponential moving average, it's not weighted as heavy, or it doesn't track the prices closely as a whole moving average. So you have like a simple moving average, which think of like an arithmetic moving average, okay? Think of an exponential, it's weighted and shorter term, typically in duration, and you have the whole moving averages. Think of those like in 3 different levels. Simple, think arithmetic average, lags. Think of an exponential like geometric, okay, where it's going to be following closer to the current price. And think of whole moving averages like technical analysis on, well, I'll just say it like this, following the stock a lot more closely, okay? It's even amped up even more than exponential. Now, that's good and bad because sometimes that actually might not be support. If we look at this and say, why do we actually like this chart, at least to consider it? Well, number one is it kind of shows us when things can turn bull to bear. If the red line is bearish, if we actually have a red line, it's showing at that moment in time on a 10 whole moving average, it's bearish. If it goes from red to green, it's going from bear to bull. That is the first sign of actually getting change outside candlestick analyses. If we actually get the 20-period moving average to actually go red to green as well, that's just showing more confirmation. That's the lagging indicator. Now, that doesn't guarantee it's going to go up. It went up for a little bit and fell back down and then did it again. And what you're going to notice is there's the 10, there's the 20, okay? And so does everyone go up like it does recently? Boy, you sure wish, okay? You sure wish they all went up like that. But so the fact of the matter is this is like in baseball, right? The batter is swinging at what they think is a strike. When they think it's a strike, they swing at it. Now, does the Major League Baseball player always hit the ball? No, they don't always hit the ball, okay? Now, bulk majority of the times they can. But the big thing they're doing here, they're kind of playing the law of averages. They're trying to get some of those who are on a maybe on even a small basis. Can they get some of these big runs? The key is to be disciplined and consistent. Selling out to the principles of investing, and notice that the practices are just that. They're just timely. They're trying to be disciplined to the consistency. And that consistency over time tends to kill. And where investors try to focus on practice and practice and practice, you need to actually probably be more focused on the principles and the principles and the principles, which are timeless. Okay? So focusing on short-term sell-offs is just short-term sell-offs. But the reality is being consistent with the principles of investing. Now, I also want to go back to one other one just real quick, because when we look at GEHC. Now, this is the GE Healthcare Technology. And if we take some of these lines off for just a second, you're going to see that the line of resistance that we actually had was right there. Now, I'm going to kind of show you some things that the paper money account likes to do. You might not like to do it, but I'm going to kind of show you what the paper money account likes to do. Now, when we look at, let's say, the IRA account, one of the stocks that's in there is GE Healthcare Technology. Now, what you're now going to notice is sometimes what the paper money account tries to show is maybe having a stock position and then trying to add on to it per se. Now, we talked about yesterday, if we had a stock position, maybe taking a different type of strategy. Here, we're just going to talk about adding to the position with a stock trade. Now, James, you didn't tell us before. I can't believe that. You already had, the paper money account already had a Morgan Stanley position. That is right. This is called like dollar cost averaging. This is, as the stock shows more trend, the paper money is showing more capital. Okay? It's not necessarily looking for new stocks. It's looking for stocks that are moving up in their direction. Now, what I'm going to do here is if we kind of say, now let's read this together, okay? Now, I said this last week with Kevin. When you, on the class on Friday, when you get these stocks to go up, and there's like those 5 to 7 days, what is the investor thinking? Bull flag bull. Well, when you get the red color candles, finally, how do you know how many red candles you're going to have? And the answer is you don't until they're happening. Everyone cannot see beyond the veil until into the future. Can't see that. So we got a red candle. Is a red candle an entry? Well, for our example, it's not. I'm not looking for a red candle. The red candle is allowing the stock to come closer to support and allowing us to look for a bounce setup. A bounce setup is actually where it starts with an upward trend. 2, red candles. We need the red candles to get the bounce setup. It's falling down. And the 3rd is the green candle. Now, if we go into the very next day, show me kind of where, do we get it? No. Get another red candle. Does that mean this isn't working? It doesn't mean that at all. It just means it's falling back down more to an area of support, which could be a line or a moving average and so on. We go forward to the very next day. What do we got? Now remember, what is the investor looking for? Well, they're looking for a close above the high of the low day. Of these red candles right here, 1, 2, which one is the lowest? Answer, it's the first. So we got to ask ourselves the question, is this green candle higher than, did it trade or, in this case, did it close above the December 1st candle? And the answer definitively is, it did not. If it did, we would actually have a green dot on the chart. I don't see that. Now remember, this day is not completely worthless. Because if we get a red candle, we close higher, what might the investor look for? Well, the investor might really be looking for the stock to what? And it starts with a G. Let's buy a vowel, A, and the last is P. Okay, gap. And the biggest actually thing is here is when you look at this, did the stock gap? I don't see that it gapped. But what we do see is the stock right now is it is trading above the high of the low day. This green dot is actually showing us that's what it's trying to show. Scripts are not guaranteed for accuracy or timing, but the thing is that dot will even show you intraday like it is. Now, what you're now going to see, now by the way, can an investor do a trade above the high of the low day? Could they be buying this in the morning, intraday, and so on without the price closing in the last 90 minutes? Yeah, they could. Matter of fact, we are now. So what I'm going to do is I'm going to right click on this chart, buy custom. We're going to go to with OCO bracket. Now, James, why didn't you do this before? Because we do all the trades in class so you can see them. Now, here's the deal. If we went back up to this and we said, well, what is that potential target that we were looking at before? We're going to say right around $87. Now remember, wait, you already have a position on this. You daggum right we are. Okay, so there it is. Now, does the next position have to be as big as the first? No, it might just be saying, look, I'm going to take another half position, and I'm going to try to get it to push to that area of resistance. So the prior target was $87. We're going to go limit day to GTC. And then, for example, the stop underneath. Now, remember, we said this yesterday. Let's go to that 3rd chart. Well, let's go to the 4th chart in. Okay, 2nd, 3rd, 4th. Why did you go to the 4th chart in? Well, the 4th chart in, that's the one where it just has the stops, visual stops underneath. Now, remember, over the next couple days, Thursday, Friday, etc., you would really, it's probably very likely that we're going to see that we could probably move up the stop at the end of the, maybe on Thursday or Friday. Because when you go back, if you said, James, I set my stops using the 8-day low, the 8-day low is still lower than the initial stop. So if I said day 1, 2, 3, 4, 5, 6, 7, 8, if we look at that 8-day low, that's why that line is showing about right there. Now let's fast forward this to, here's Thursday's candle, and let's say here's Friday's candle. Okay, 1, 2, 3, 4, 5, 6, 7, 8. So if those Friday candles look like those gray ones above, that stop could probably be moved up to near 78-ish. How did you get that? Well, if this is Friday's candle, this is Thursday's, hypothetically. The 8-day low candle is right there. So that means that that white line could probably go up quite aggressively. I'm not saying it's going to. The stock could go down Thursday, Friday. Who knows? But if it did that, that's where that low would be, that white line. Okay, so now what I'm going to do is I got a target right there, data GTC. I'm going to set the stop exactly where it is, 74. Okay, 74.91. Now, knowing that that's the initial stop, the chances that that is going to be moved up Thursday, Friday, perhaps I'm not going to ever say the word for sure. Highly likely. Okay, whatever that means to you. And I'll fix that. But we're just going to add those 50 shares to the position, making it 150 shares. Now, when you go back to that and say, well, what does that look like on a 3-year weekly chart? It really looks like something that looks like the hood chart. What do you mean by that, James? I'll tell you exactly what I mean by that. It looks like a stock that kind of like broke down right around the 80. And that top side was probably right around 89-ish to probably right around the 92. Okay? Now, if I back that chart up to a 3-year weekly chart and say, what does this look like? This is what I kind of meant by that. It looks like the hood chart. Horizontal support, which acted as resistance. And then the stock is just chopping its way back inside of that channel. Now, remember, if you're a bearish investor, you're saying, wow, an entry signal to go bearish is probably not a stock that's breaking resistance to the upside. So a lot of times bears will say, look, I'm going to go look for something else that has more of a shorter term downward trend. Now it's kind of a lot of times more left to, do bulls want to get in? New investors. But the other thing is, could current investors, if they have some capital remaining, could they try to add to the position and dollar cost average? Okay, that's going to be something we're going to be watching. Okay, now are there any questions? Any questions? So trade number 1 we actually did here today was hood. Trade number 2 we actually did here today was MS. Trade number 3 we actually did here today was GEHC. Okay, now any questions? So I want to go. Now, by the way, okay, the other question was asked was regarding kitty cat. Now, let me kind of just bring something up to you. So what I like to do, and so you're going to kind of see that if we look at this, what you're now going to notice is, as I kind of see things sometimes, I like to kind of post about them. They're examples. They're not recommendations. Well, you're going to see about an hour ago, I kind of wrote long tail on cat. Now, we talked about Caterpillar yesterday, okay? And what you're now going to notice is, if we look at Caterpillar, what did you mean by that? Well, this morning, earlier on, you actually saw the price drop down quite a bit, and it really got down really below that higher low, okay? So it dipped down in the morning. Matter of fact, it dipped down 20 points, about 3% or so, and it pushed right back up. Now, it's not like we've closed here, but someone, again, this kind of goes back to the hood type example or the GEHC example. If people are buying below the higher low we could quickly see right here. If someone's buying below that, someone really thinks that maybe stock could actually go back to the upside. Now, that's what they're thinking. We're going to find out. But that's kind of like even in a shorter term compared to hood and GEHC. Now, this is going to be interesting to watch, because what you're going to notice is this is kind of in your kind of copper bull type pattern. Horizontal support up in an area of resistance. And this line right here, there's your resistance, your 2 touches, okay? So if we're talking about maybe could, and we don't know, that's why we put the paper trade on, we're going to find out, okay? Taking calculated risk with a position size, that channel width is about $30. $30 on top of, let's say, 582. It gives us that target of 612. Now, again, a target is just a target. We don't know if it's going to go there. And so it's going to be something to watch. Can that stock maybe close at the high of the day and not leave an upper shadow? If it does that, some of those investors who are in might try to add. Some of those investors who aren't in might try to get in general. And if that actually goes up to that level, those bears might say, hey, thought Caterpillar was actually going down, but so far it's actually showing more strength than we thought. We tried to push it down. It's been unsuccessful so far, okay? So I just want to kind of point that out because there was a question on that. I would not read on that it's bearish, given the sell-off that I had and the pushback to the upside. We will continue to watch that, okay? Now, I also want to give you a quick reminder, stay tuned for our next class. You're going to see that if we go to this page right here, it's going to give us the Trader Talks Schwab Coaching Webcast page right on YouTube. Take a look at that. It will actually show our next stream. Also, make sure you go to schwab.com, go right to where it says learning. You'll see our live classes and also our in-person events. Join us next week. We're going to be got some in-person events coming up. Ben, Barb, Rachel will actually be there, so join them there. Want to also thank you so much for your comments and your participation. And also remember, with what we discussed, it was done for example, illustrative purposes only. Did 3 sample trades with us here today, and we'll follow through on those Thursday, which will be the trend trading class at 1 p.m. Eastern tomorrow. Join us. And then Kevin and I will actually do the class on Friday. Now, that's live only. That's right at 9:30, and that is on the topic of ETFs, all of it. Okay, domestic, international, and all of it. That is not recorded, so join us there live Friday at 9:30 a.m. Eastern. Thank you, Ben, and stay tuned for our next webcast coming up at the top of the hour. Take care. Bye-bye.